Welcome back, everybody. Y'all are sick if you're that into this stuff, but I appreciate y'all watching. Hopefully, you learn a little something from this. EBIX. If you recall from our premium content video over the weekend, we did put an order in. If you looked at the website, spoiler alert, we got filled for the full 70 here. And after that filled, I actually sold another contract. And I'm still going to keep this in one contract increments so that you can customize, scale it to your learning for your account size, okay? And this is not a brag. This is just me trying to spread information to folks because I wish somebody had showed me. But anyways, I actually sold another one for $35. And this is on the put side. It's a 1027 put at 550. Okay, and this was a 1027 call at 550. And you'll see why that matters here in just a second. So I want to break down this position because it can get out of hand, and hopefully this should express to you why you don't go all in on trade, right? You need dry powder. So right now, the stock is at 573, okay? So that's what's 23 into 550? Roughly 4% above where we want to go. Now, I want to talk through the scenarios because I really don't think that people understand what they're getting into when they get into options. Now, nobody knows what will happen in the markets, especially on one particular stock. So, but we know that there are only three possible outcomes: up, down, and sideways, right? So up is best case scenario, sideways is best case scenario, and it can even go down 4%, down to 550. All those scenarios play out wonderfully for us. And let's express it in money. If any of those things happen, I pocket $105. All right? Now, another scenario can happen where it goes below 550. Okay. Then you would call this a win. Okay. Because I collect this $70. I just get to keep it. You know what I'm saying? And but obviously I would like for it to go up or sideways so that we collect this. We sell the 100 shares that we got assigned, right? And we can keep this too, right? So for a little quick math, so you don't understand why I did it, the $35 is risk of $550, okay? So I got paid 6.36% for 1 week. There are 50 of those in a year. So annualized, it was roughly 318%. So you can see that when these kind of opportunities present themselves, I like it. So if it goes up, we win on this one, on the put. If it goes down, we win on the call. Okay. But if it goes sideways or anything like that or whatever, we'll get rid of these shares, which we want to, because our cost we'd be collecting 620 and we only paid 600, right? So 20% or $20 is over 3% for 1 week. That's pretty good. Plus we collected this, right? So let's break down the last scenario where this stock just tanks. And I hate to even say the words, but it's possible, right? I mean, this is not like a good company, but even if it was a great blue chip name, it could still happen. But let's illustrate this. I guess we have to do it. I'm not smart enough here. So we've collected $140 in premium. So we'll take that off the 550. So 410 plus 600, which we paid for the into 2. So that would take our cost basis to $5.05 a share. And as you can see, the next strike price is right at $5. See? And there's plenty of premium here. So even if the stock continues to fall, our cost basis is down another 10% from 550. You see, so even though we don't know what the market will do, we've got a significant edge here because of the volatility of this particular stock at this particular time. Now, this isn't like my always go-to or whatever, but it hit the screener. It's got decent financials, and it's got awesome premium right now. When the stock calms down, the premium will disappear. So I wanted to kind of go through that. So, you know, if everything goes up instead of 620 now, we collect this extra 35. We get up to 655. So 55, we paid 600 for it on Friday. That's 9% in a week. You see, if it works out. And, you know, we got 2.5 out of 3, if you ask me. I mean, we got 4 more days left and 4% wiggle, but this is a volatile stock, and this is risky, but everything in the stock market's risky, man. You think people that just buy the S&P all the time, every day, every paycheck, they just buy the SP, buy the SP. What do you think they did when we were hitting the circuit breakers during COVID? They were shitting their pants, probably. You know what I mean? So even the safest investments have risk, right? But the richest people in the stock market are experts at how they manage the risk. So by collecting such a huge percentage every week, the stock can go down even a huge percentage to match, and we're still keeping pace with it, you know. So, and this one's, I mean, $550, so no big deal. So I wanted to go through that. There won't always be a video on Mondays, but I pulled a little audible. And if you think, well, if that was currently the plan, why didn't you just sell it at the open? And if I'd have sold the put at the open, I'd have collected like double the money. But I really wanted to get the call sold first. Okay, so that shows you, if you look at the chart, we're at this double bottom, potential double bottom. And what happened when price reached this zone? You know, shot up. Didn't go up crazy, but we're not looking for it to go up crazy. We're looking for it. There's Monday. Yeah, so we started down here. And look, it did find some support here, didn't it? And then what we do? Sideways. Sideways is a dream for somebody that sells premium. So I hope this is helpful to you. Reach out if you got any questions. And don't look for any more options videos. It's set it and forget it. I don't care how the price moves. We'll figure it out on the weekend. So have an awesome rest of your evening. Thanks to the diehards. And hopefully some of this makes a little sense. So have an awesome evening. We'll catch you tomorrow. Peace out.